Hello, guys. I'm back again with the second lecture on REITs. In our first lecture, we had the opportunity to look at a couple of things in relation to REITs. One of them being the concept of a REIT, the second being the different types of REITs, the third being the different stages of a REIT, and then also the difference between a REIT and a property company. In this second lecture, I'll be looking at the REIT market in terms of its size and performance over time. I would also be looking at the rules that govern the establishment of REITs as an investment vehicle and the distribution of its income, which is one of the main reasons for investing in REITs. And if there is time, I will look at how REIT income can be measured. Let's start. What is the size and performance of the global REIT market? Here, I would like to share with you data on the size of global REIT. First, across countries and across regions. This chart here shows the global REIT market in terms of market capitalization across countries. It is clear that the US REIT market is the biggest, with a market capitalization of over 350 billion US dollars. Indeed, the US REIT market is arguably bigger than the sum of the REIT markets in all other countries. Let's look at this second slide. Like all companies, access to capital remains a critical business priority for all REITs, and the ability to raise funds in an accretive manner remains a driver of global equity market activity. This diagram shows how much capital was raised by REITs globally each year from 2012 to 2017 across different real estate assets. And here we have multifamily residential homes, hotels, industrial real estate, healthcare real estate, office real estate, diversified real estate, retail, and others. These figures exclude capital raised through IPOs. An IPO is a short form of initial public offering, which is the first time a company goes public. In other words, the first time a company lists on the stock market. Through the first half of 2017, 32 billion US dollars was raised globally, which is broadly in line with recent years. It is, however, the lowest capital raising since the year 2012. Between 2012 and 2017, the highest amount of 80 billion US dollars was raised in the year 2013. This diagram also shows how much capital was raised by REITs globally each year from 2012 to 2013 across different regions. So here we have North America, we have EMEA, we have Asia Pacific, we have Latin and South America. The first half of 2012 saw positive signs for REITs, with a steady flow of IPOs globally. 9 markets have seen new listings, with a total of 4.2 billion US dollars raised through the first half of 2017. IPO activity remained before 2018 below the 2013-2014 period, when recovering market conditions the introduction of new REIT jurisdictions, and a wave of portfolio IPOs in Japan in particular drove activity. With the exception of a high-profile US IPO that raised 1.5 billion US dollars, global IPO activity was primarily focused on small entities, with 38 organizations raising 9 billion US dollars in the last 12 months. That is prior to 2017. This chart also presents the size of the top 10 or the biggest 10 REITs in the world in terms of market capitalization. So it is quite obvious from the chart that American Tower has the biggest market capitalization of about 50 billion US dollars. Now let's shift our attention to the performance of REITs. In last semester, we learned about some of the statistics used in measuring the performance of REITs. We talked about average returns, and then we also talked about how to measure the risk associated with returns using standard deviation and the variance. On this slide, I have data up to the year 2010, covering the average annual returns of REITs in comparison with other asset classes. These other asset classes include equities, as measured by the Standard & Poor's 500 index, bonds, as measured by the Merrill Lynch Bond Index, direct property, as measured by the NICREF Property Index, REITs, as measured by the Wilshire Real Estate Securities Index, global REITs, as measured by EPRA, small stocks, as measured by the Russell 2000 Index, and the Consumer Price Index, which is a measure of inflation. Except for the 3-year period before the year 2010, the US REIT market outperformed all the asset classes, and for that period, only bonds outperformed REITs. Only REITs and bonds enjoyed positive returns over the 3-year period that ended in the third quarter of 2010. The 11.03% average return on REITs since 1980 exceeded other returns by a significant margin, a fact that is often trumpeted as a reason to invest in REITs. In this second slide, I show you the performance of REITs over a 40-year period before the year 2010. REITs have generally provided returns similar to the Standard & Poor's 500 index and have periodically been subject to down years every 10 years or so. This chart reviews the annual returns of the FTSE Nareit US Real Estate Index series from 1972 to the year 2011 and compares the total US Nareit Index with US equity REIT returns, not including timber REITs, and with US market REITs returns over the same period. The chart also reviews that mortgage REIT returns have been much more volatile over the last 40 years than have been the equity REIT returns. So in terms of volatility, we have said and we know from previous lectures that we can measure the risk or the volatility of the returns associated with an investment asset by measuring its standard deviation. Oftentimes, what is not reviewed by REIT promoters is the risk or the variability that comes with the returns of REITs. The risk of variability of these investments is measured by the standard deviation of their returns. This table exhibits the annualized standard deviation of the quarterly returns and demonstrates relatively high REIT volatility, the highest of all the assets shown. The relatively higher variability or volatility of REIT returns may explain its relatively higher returns, which is consistent with the theoretical securities market line, which we studied last semester. Now, let's shift our attention further to look at the rules governing the establishment of REITs and the distribution of REIT income. Here, I will provide the rules governing the US REIT market and the rules governing the UK REIT market. Let's start with the US market. REITs, as we know, are tax neutral or transparent vehicles provided that they meet the qualification rules. In the US, these rules include the following. 1. That there must be a minimum of 100 shareholders with limited insider dominance. 2. At least 70% of total assets must be held in real estate or real estate related assets, cash, or government securities. At least 75% of gross income must be generated from rents of real property, interest on mortgages, gains on sales of property, and dividends from other REITs. And lastly, they must distribute 90% of the REIT's taxable income to shareholders. In the UK, similar to what pertains in the US, property rental business with 75% of income arising from that business and 75% of assets are supposed to be dedicated to a REIT. UK REIT may carry out taxable ancillary activities which can include property development or redevelopment. The UK REIT must distribute at least 90% of the profits of the property rental business. This excludes capital gains from property sales, though it can either be distributed or reinvested in the portfolio. However, as long as these tests are satisfied, a UK REIT may carry out taxable ancillary activities, which can include property development or redevelopment, which we have said is one form of real estate investment strategy. Now, how do we measure REIT income? To satisfy the requirements to be a REIT, 90% of net income must be passed through to shareholders as dividends. However, when analyzing a REIT, net income is not considered the true earnings of a company, but is thought of as an accounting convention. Other alternatives to net income, like funds from operations and adjusted funds from operations, have become widely accepted by REIT and analysts as being more effective at measuring the true returns of REITs. And this will be discussed in this section. I will end here with this second lecture. and I will provide the detailed analysis of how to measure REIT incomes in the next video. Thank you.